Welcome to the podcast that's dedicated to helping business owners to prepare their business for exit so you can maximize value and exit on your terms. This is the Exit Insights podcast brought to you by Succession Plus and Capitalize. I'm Daryl Bates-Brownsword, and today I'm talking to Oliver Wilson from Showbrook Bank. Now, today when I was talking to Oliver, I had a number of questions that were brought to me by a number of customers, clients, people I know out there, all asking about EOTs and exiting to EOTs. Now, Showbrook have developed an expertise, some specialization in funding EOT exits. So I wanted to pick Oliver's brains and see what's good, what's bad, what's viable, what some of the options are, and what makes it attractive to owners and what makes it attractive to banks and other funding agencies to want to fund this type of deal. Unfortunately, we had a little glitch right at the beginning of the podcast, but there's no major issues. We just lost the first minute, really just this intro section. Well, I was asking Oliver, with the growing of EOTs, what is it about the increasing popularity of them? Why are they an option? What makes them attractive to owners, but especially the funding and how the owners can de-risk part of the exit by getting funding so they can take some cash with them when they leave right at the beginning, and that really energizes them and the employees moving into the EOT. Oliver suggests that funding becomes attractive when a business has got an EBITDA of at least £1 million. So we're talking Showbrook, are based in the UK, so it's a UK option at the moment, a specific. And with EOTs are really taking off in the UK at the moment, and they're exponentially growing year on year. We were asking about what are some of the risks and what are some of the considerations of the situations that would make it viable for funding. And we pick up the conversation here halfway through this question.
The vendor is taking off the table, because I think the important thing for us as a lender is that there is an alignment of interest between the board of directors and the management team who are operating the company on a day-to-day basis, the outgoing vendor, and us as Showbrook as the lender. So it's important that we all understand each other's kind of driving forces and motivations in the transaction. So, in a scenario where somebody is exiting 100% to an EO, that then has another dynamic to it as to whether they're getting all of their money off the table on day one, which is typically not the case. Or whether there's a significant chunk of money, being deferred and being paid to them over a period of time, and the dynamics for how that operates, inform the lending assessment. Because typically, with an outgoing vendor, it's beneficial to have them incentivised and invested in the future success of the company, having been, a vendor group who've operated that company successfully. If they're only selling 51% of the company, then of course that automatically creates that alignment of interest, because the vendor still owns 49% probably of the company going forward. So a lot of it's about alignment of interest between the different parties. I think certainly it's harder as a lending proposition. It becomes a little bit more like a management buy-in type scenario, where a vendor exits 100% on day one with all of their money, and a management team is perhaps stepping up into leading the business, who aren't equity incentivized, haven't perhaps had that level of responsibility before, and you haven't got a vendor who's incentivized either, and that's a less desirable scenario.
So we've got the management team who continuity of the management team is desirable. So one thing we haven't discussed is, I guess, size of the business. So is there a business size that's moving to EOT that becomes viable for funding, or are there businesses that are too small to be viable for funding? I imagine there's a cost to get the funding, so the business needs to be making a certain amount of profit, and then also, I guess, the percentage of funding that you guys you have an appetite for. If 51% of the business is being sold to the EOT, are you looking to fund the whole 51%, or is it 50% of the 51%? So many questions.
Yeah, no, indeed. And I think a fairly typical scenario would, and this would be the same across all lenders, whether it was Showbrook or a different lender. So every lender operates their own kind of size point, risk point sort of structure. I guess for us to do EOTs, we're typically looking at businesses with an EBITDA, a sustainable EBITDA of above $1 million. I guess most of the deals that we operate are probably for businesses of EBITDA 1 to 6, 1 to 7, that sort of space. And that's more about kind of where Shawbrook sit in the market than anything specifically related to EOT. But there is an expectation that if you're going to put debt into a business, it has to be of scale, defensible enough, resilient enough to be able to reasonably be expected to repay that debt. And I guess size is a proxy for that. So I guess typically $1 million EBITDA on a sustainable basis and above would be a good sort of start. In terms of the quantum, I guess that depends. We have a sliding scale of how much debt we're willing to put into a business based on the kind of features and characteristics of that business, and that could range from maybe putting in 1.5 or 2 turns of EBITDA, all the way up to 3 or just over 3 turns if that's supportable within the cash flows of the business. The lion's share of the deals that we do will fall in the 2 to 3 turns of EBITDA multiple that we would put in as a debt structure, and typically a fairly typical structure would be that the vendor would take 50% of whatever the EV for their shares that they were selling for out as cash on day one, and 50% would be on a deferred basis, and we may fund up to the full amount that's being taken off the table on day one.
Okay, so a bit of jargon used there, and some of our listeners, may not have sold a business yet, and I know that some of them are in the early stages of their exit planning journey. So I might just explore and dig deeper into some of the jargon there. 50%. So if the business has got about £1 million in EBITDA, they're a significant size. They're quite profitable. They've got a number of 30 plus employees in the business in all likelihood. So they've got a robust or an existing management team in place, of more than 3 or 4 people in the management team, the people in the driving seat of the business. They're likely to stay on. Is part of it. We talked about EV, which is enterprise value of the business, which is just one of the ways of determining the valuation of a business. And I think you said, and I'll just try and translate, and please pick up if I got this wrong, but if you're going to fund, you may end up funding about half of the valuation, and the owner may expect to walk away with about half the money up front, and then expect to get the rest of the money through the vendor financing or the financing using future profits of the business to fund the acquisition by the trust. How's that? Yeah,
that's a fairly typical scenario. It might be easier to do it in numbers. So you might say if the enterprise value of the business was 5 million, let's assume it's 100% sale. So if the enterprise value was 5 million, you had an EBITDA of 1 million. It would be a very typical scenario where the bank would lend 2.5 times that 1 million of EBITDA to give you 2.5 million of lending, and that would be used to provide 50% of that 5 million valuation to the vendor as cash on day one, and the remaining 2.5 million that was due to the vendor would be payable by the business, future cash flows on a deferred basis, subject to some controls that the lender, like Shawbrook, would want to make sure that those interests are aligned between us and the vendor. So that would be a fairly typical sort of structure and scenario to enable that sort of transaction to happen.
So the future profits of the business are used to pay back the loan by the trust, and also pay back the founders or the exiting shareholders of the business. And,
correct.
Yeah, and that's and in your experience, Oliver, what's the average repayment time frame?
So I guess typically for these types of transactions, and this will depend again on the risk structure, but we would typically put in a 5-year loan, and that would range from being a fully amortising loan. By that I mean it's fully repaid in equal instalments over the life of that 5 years. But sometimes for businesses where it's warranted, we might allow a proportion of that 2.5 million in that example to be a non-amortising, i.e. to be interest only. We call it a bullet loan, so it just becomes payable in a lump on expiry of the 5 years, and then some of it amortising. So again, a typical scenario might be of the £2.5 million loan, we might say 1.75 million of that is amortising, and 750,000 of it can be interest only and payable in a lump at the end of the 5-year term.
Okay, and I imagine you. So you just started to explain that every business is different, and they're going to be options depending on the cash flow, and I guess the industry that the business operates in, and the owners, and the real details get down to that. So let's say a business is looking to go down this route. In terms of valuation, how do you determine a value of the business? Do you use some sort of third party? You got in-house?
Typically, businesses, by the time they approach a lender like Showbrook for debt, can be at any stage in the process, but typically they will already have an idea of what the valuation is, and that will usually because they've been advised by somebody, perhaps somebody like Succession Plus, who gives them a valuation of their business that they can use to construct the transaction. As part of the OT, it's a requirement to have a formal valuation of the business to avoid vendors either under or over inflating intentionally or otherwise the valuation. So it's a requirement that a formal valuation is done and signed off, and that would usually be what we would look at, and then we would sense check that valuation based on our experience of other businesses in the market of similar sector, of similar size, with similar dynamics, to get a sense check of whether we think that feels like a reasonable and sensible valuation for that business.
Yeah, so we don't want people overvaluing their business. It's got to be still, even though they're selling it to employees, and it's always a case of buyer beware. It needs to be a fair valuation for the business.
Correct.
Okay, and once they've decided to go down this route, they've got a valuation for the business. Hopefully, there's been some sort of assessment and engagement with the workforce that this is an option they want to go down. I know that sometimes that doesn't always happen, but how long does it take? They start engaging with you guys and go, look, can we get funding? How long does that part of the process take?
I think, again, it varies from case to case, but I would say, the bank are rarely or certainly at Showbrook anyway, we're rarely the people who slow down a process. So, there's lots of moving parts in these sorts of things, but I would say, 8 to 12 weeks is a fairly typical time frame if everybody's motivated and wants to get it done. But many of them take longer because they engage, with us early, and I would encourage businesses considering this as an option, particularly where they're wanting to or considering putting debt into the business to help the transaction, to engage with your lender early so that they can go on the journey with you and help advise and help you shape how you set up the transaction and the information and the decisions you're making along the way to make it the smoothest path. And that means it might, the engagement might be a little longer, but it'll be time well spent in the end.
Yeah, it's like many things, isn't it? Do the planning up front and be prepared, and the execution will be a bit smoother.
Absolutely right, yeah, for sure.
So it may be a bit of a trick question, this, but some of the business owners have come to me and sort of said, how does it all work? Who's got the liability for the mortgage or the loan rather? Who's got the liability? Is it the trust? Is it the employees? But the employees don't want to take that risk. Is it the business? Who's got the liability? And do I get my money first, or does the bank get their money first?
Okay, well, I'll answer that in the reverse. In that the bank always gets their money first. So that's a given, really. So a security structure, the bank will take security, and that will typically be a debenture over the company, but that will include incorporating both the trust and the operating company, because ultimately it's the operating company who are generating the profits that are servicing the debt, and that's where the enterprise value sits, is in that kind of operating company. So typically the security structure will encompass both the trust company and the operating company, to make sure that that's all kind of aligned. And I guess one of the principles of lending in these scenarios is that the loans that are being put into the business are what we call senior loans, which means they rank first, they have priority over everything else. So that includes priority over everyone really, apart from HMRC. So and so that includes vendors. So the bank, Showbrook, we will always want some level of control and oversight about how much of the vendor's deferred consideration is being paid out of the cash flows of the business whilst the debt with the bank is outstanding. So I guess the worst possible scenario is where repayments to to pay an outgoing vendor cause the business to default on its debt because it hasn't got the money to do that. We're very keen to protect against that. So you repay the bank debt first, and then other stuff comes after that.
Okay, well, no surprises there, really, are there?
Indeed, no.
So the business owner's thinking, okay, so I need to make sure, and they've done all their modelling and financial modelling and maths and determined that it's affordable, etc., and modelled their payments back to them after the bank's received its money. The next question that I've been asked is, hey, look, as a business owner, when I've gone to the bank for funding during the growth periods of my business, the bank has always asked to secure that funding against my personal assets, like my house or what have you. I'm exiting the business. I'm reducing my involvement in the business. Do I have any other outstanding risk if the bank are going to fund the acquisition of the business? Am I exposed through any of my personal assets and have additional risks in that way?
Typically with us, no, in the sense that that kind of personal element of security, I guess, is much more prevalent in smaller businesses. And I would say, we've used an example of business with 1 million EBITDA. I guess the average size of businesses that we work with is probably more like 3 or 4 million of EBITDA, but can be smaller for sure. And I guess the reason we target that space is because we believe that the businesses that we want to lend money to in that size point are resilient enough to stand on their own 2 feet, independently of the owners' personal assets and situations of those businesses. So unless there's a specific reason why we should, typically we don't take personal security, personal guarantees, charges over residential property. That doesn't form part of it because we're making an assessment of the business, its ability to service the debt and the enterprise value that sits within that business, and that's the basis on which we're lending money to it. So that means it's completely separate from the vendor. So really, going back to your first question, because we've made the same business risk assessment on an EO transaction as we would on any other, that bar has already been met in that way. So the only real risk from a personal perspective that the vendor is running is that if for some reason the business fails and there is a problem, maybe the bank has to take some kind of action or another. Obviously, any deferred that's still due to them clearly remains at risk and wouldn't get paid until the bank was repaid. But beyond that, in terms of personal risk, there is none. Okay,
great. So it's looking pretty good for the owners. We're now moving down the route, and we've had a chat to Showbrook. As an aside, Showbrook's not a high profile bank. It's perhaps no one in the business. But how will they find Showbrook? How does the business community bump into someone like yourself?
So I think it's a mixture of routes, really. And actually, I suspect if you Googled EOT funding, you'd probably find Showbrook would come up pretty quickly. So we do get quite a lot of inquiries directly from people, looking on the internet and kind of typing into Google what they like. But I guess the majority of it is through advisors. We work both directly with businesses transitioning in this way who we know through the networks of myself and other individuals within the organisation, but also really, your advisors, whether that be your financial tax advisors, whether that be your accountant or corporate finance advisor, whether that be your legal advisor. I guess a lot of the introductions that we get will be via one of those advisors who's working with you, who know us, know what we've done, hopefully have worked with us before and can say, look, go and speak to Showbrook. They're a good bunch who know what they're talking about in this space, and it'd be worthwhile talking to them.
Yeah, and as you alluded to, you are actually one of the leaders in EOT funding.
Yeah, for sure. It's one of those areas that we first. I think we funded our first EOT transaction nearly 3 years ago now, and have done many more since. And it's an area that we understand, and we think it's going to continue to grow. So it's a sort of central part of our loan strategy in this SME market. Okay,
and given that you are one of the leaders and you have, I guess you have funded a number of EOT transactions. I imagine there's a whole lot that you haven't funded, and what are some of the red flags that you see and you go, oh, we're staying away from this one, so that owners can perhaps recognise those red flags in their business today and address them before they come and speak to someone like yourself and prepare their business.
Sure. So I think if I separate the question and focus really on the stuff that's pretty specific to employee ownership transactions, as opposed to general stuff where the business risk just doesn't stack up or doesn't look attractive to us. For EOT, I think there's three areas that the owners who are thinking of putting debt into their businesses as part of these transactions need to really think about and prepare for in advance. The first one's quality of information. So I guess one of the features we quite often see in businesses, particularly at the smaller end, who haven't had debt before, particularly going into employee ownership, is where the quality of the financial information isn't good enough to enable a bank to get enough visibility over what's going on in that business to be able to be comfortable putting debt into it. So as a minimum, fully integrated financial models with a P&L, balance sheet and cash flow, really good monthly MI packs that include balance sheet, P&L, cash flow, that include the KPIs of the business, presented in a format that's clear, that allows somebody to assess how that business is performing in the context of its market and where it's expected to be. So financial information and the quality of it is one, and I guess feeding off that is making sure that you've got a robust finance department, finance director, finance manager, someone qualified in the business to produce that information for the bank, because when you're putting debt into a business, the bar of information is higher than for a business, of course, where you're not doing that. So number one would be making sure you've got a good finance function, a dedicated qualified finance manager or finance director, and good quality management information. And banks like Showbrook can kind of help guide you as to what that can look like and provide examples for people of the sort of level of information expected. So that's number one. Number two and number three are kind of variations on the theme, really. But number two for me would be very, very clearly defined board of directors and management structure in the business, because typically with a vendor who is exiting, or at the very least taking a step back, perhaps from the day-to-day operations of the business, it's really important that in an EO environment that the board of directors is really clear on what their role is, what their responsibilities are, how often they're going to meet, who's making the key decisions of the business, and what the strategy they have set for the business is, and how they're going to deliver that. So a good kind of governance structure around the kind of leadership of the business and what that looks like and how that's going forward. And the third point follows on from that, which is the extra layer of governance that sits around the EO structure through the board of trustees. And I guess we would always encourage people to have at least one independent trustee that sits on their board of trustees that can hold the management team and the leadership team to account for the financial health of the business, the delivery of the strategy of the business. And that gives lenders like us a lot more comfort that the EO is being set up with the right intentions, with a good form of governance around it, and an appropriate level of challenge and oversight for a board of directors who may be stepping up into more senior roles than they've had before, but now have a responsibility that goes beyond being an owner-founder, where you're running the business ultimately for the benefit of the shareholders, transition that into running the business for the benefit of the beneficiaries of the trust, which are the employees. And I guess that extra layer of governance has an expectation for us as a lender that the management team are going to be able to be held to account for how they're operating that benefit, that business, given that the beneficiaries are ultimately the employees. So I guess they would be the sort of two or three things that we focus on quite hard for EO. And the absence of those things, I guess, leads us to believe or question really the motivations of the vendor. If the motivation for the vendor is, I've tried to sell to PE and I don't really want to do that and I don't like it. I've tried to sell to trade and I can't get the valuation I want, so I'm going to sell it to the employees through a relatively friendly employee ownership transaction, take my money out with the tax benefits, thanks very much, and walk off into the sunset. If that's the only motivation at all for somebody doing it, that's not a particularly appealing lending prospect. Now, I'm not going to pretend that the tax benefits aren't a part of it. Absolutely it is, and it should be, but that's got to be balanced with all the other things, the cultural aspects and the benefits that it can bring to the business for a longer term.
Absolutely, and I think, I couldn't agree with you more there, Oliver. I think, personally, Succession Plus, we're big fans of employee ownership, but it has to be done in the right way. An employee ownership structure, succeeds when you've got an employee ownership culture. People need to understand what the business is all about. They need to understand how the business runs and the decisions it makes. It's still a commercial business and it needs to be viable. Just so happens that the key stakeholders or beneficiaries also own the business, but they've still got to run and operate the business. We need the viable.
Sure. And most of the businesses are done for the right reason. And I speak to lots of businesses who've been on the journey for 2 years prior to actually undertaking the transaction, because they've been changing the culture, building the team, developing their people so that they're ready to take on the roles and responsibilities that they have when the transition occurs. And they're the sorts of businesses that we love working with, and most are like that.
And you touched on something earlier as well, Oliver, when you were talking about the role of the trustees, and the trustees are there to look after the beneficiaries' interests. But what they also represent is the largest shareholder or shareholding of the business. So they have a communication aspect in terms of keeping the board accountable as well.
Correct.
And you didn't say this, but I think of what I heard, and I'll just check in with you if I heard this correctly, it's attractive to you if you've got someone who's experienced in a non-executive role on the trustees, because they can look over the fence, so to speak, and keep the new directors and almost mentor the directors and keep them on track and accountable to where they need to be going and taking that business forward, because is often linked to ongoing growth of the business and taking the business to the next stage. So having someone of that level of experience and capability is a big helper or a green flag, if you like, when you're bringing the funding or providing the funding.
Yeah, you've absolutely hit the nail on the head there, Daryl. It's really important that, like you say, it is still a commercial business, a different ownership structure, yes, a different level of responsibility, but much like having a non-exec in a non-employee owned business, I guess because of that layer of governance and that extra responsibility to the beneficiaries of the trust in the employees, it's really important that an independent voice sits on that board of trustees as a measure of oversight and governance and control to make sure that they can hold the management team to account for delivering and protecting the business and operating it in the right way. That's like you say, a real green flag, and that's very different to, it's quite hard sometimes for owner founders who've operated businesses, effectively for themselves, for their family, for the last 30 years, who are used to making all of the key decisions in the business pretty much because that's the way it's been successful. Moving away from that mindset where you can't operate it purely for your own benefit, and doing that, in a way that has some governance to it is really powerful. The converse of that is, we see these every now and again where you have an owner founder who's stepping back. They're now going to sit on the board of trustees along with one of the members of the management team and one of the friends of the founder vendor who happens to be an accountant. And that's not a very robust governance structure, because ultimately no one is going to challenge that vendor, that person who's been used to culturally making decisions on their own for 30 odd years. So, that's the converse of the situation.
So a truly independent director is what you're looking for by the sounds of it, not
ideally, yeah.
Yeah, and I've seen many where the business accountant just slots in, who's helped with the transaction and the transition, just jumps in as the independent director, and they've got a lot of great business experience. But what you're saying, if I understand, is they understand the tax structure, they understand the structures, they understand the entity, but are they the sort of person that really is going to hold people to account and hold their feet to the fire and challenge and help transition the business to the next level?
They're not ultimately independent in that sense, are they? Because they're still being retained and paid by the company, as their accountant. So, there's a natural conflict there where they recognise that if they upset people too much, they might not be the company accountant anymore. So, that has a consideration to it. Yeah.
Okay. Hey, and look, there's so many more questions that we've got. So, one of the questions that I hear a lot is, okay, we've sold our business to the EOT. We may have completed the EOT. We're now 100% EOT, or we're 100%. The founders have exited the business. we're 5 years in, for example. What happens after that? Is there an exit after EOT? Like the business may continue to grow, and they may have a PE knock on their door. They may have a large international trade player go, hey, look, these guys would be great as part of our portfolio. Yeah, and I know on paper the trustees have they've got to look after the beneficiaries. What are the options there?
Yeah, it's an interesting one actually, and not a path sort of really well trodden so far, in the sense that there hasn't been. It's still, whilst the structure's been around for a while, I guess it's increased in popularity exponentially over the last kind of couple of years. So there isn't a huge kind of backlog of transactions that have occurred and then operated in the employee ownership structure for a long enough period of time to then become a sort of appealing as a sort of secondary acquisition. But there's no reason why those things can't occur. I think what you do tend to find is that for many, the businesses that go down this route, part of it is creating a legacy for the founders of those businesses, and controlling and building what that legacy looks like. So a lot of businesses go into this structure with no real intention ever of operating in any other way. It's a long-term decision that they take to transition to employee ownership and operate that way ad infinitum. Others do it and sell less of the business and retain some upside potential in the future. So there's no reason why any other options are barred to a business or an owner just because they've transitioned into employee ownership. They still are able to be purchased by other buyers at some point in the future. But I guess at the moment we haven't seen loads of cases where that's actually happened, both because of the reasons for doing it in the first place and just the longevity of the structure in this market. Yeah.
And as always, the trust should get the right tax and legal advice of the opportunities. Hey, look, Oliver, this has been fantastic. I'm sure we could continue on, but from your perspective, what's the key message you want listeners to take away from this conversation with us today? What's the number one things they need to consider before looking at finance?
Sure. Well, I think thanks for having me on, Darryl. But I think the number one message really is that I think a lot of people don't realise that you can help facilitate these structures by putting debt into do it. And I guess my number one message to people would be that if you've got a good business that kind of has those dynamics that we talked about right at the start, and you're considering going down the route of employee ownership, be aware that putting some debt into that business through somebody like Showbrook is an option to do that. And if that's something that people want to consider or think about, then we'd be delighted to hear from them.
That's brilliant. Yeah, look, for me, it's the awareness that the EOT is, I think you said, growing exponentially, and it is, yes, and therefore the options available, and I guess the support industries around that are growing as well, and funding is absolutely available, as a commercial viability and a really attractive proposition for the right businesses. So
yeah,
really
absolutely.
Insights.
No, thank you, Darryl. Appreciate being invited on, and hopefully speak again soon.
Cheers, Oliver.
Thank you.